The closing bell rang just about 15 minutes ago on this Wednesday, March 11th, 2026, and here is the final scoreboard. The Dow gave up 0.82% today, bleeding over 300 points dragged down by 3M and P&G. The S&P 500 slipped 0.18% to settle right at 6,769. But the Nasdaq somehow scraped out a 0.12% gain.
Yeah, and that divergence right there is the entire story of the session.
Yeah.
I mean, we are looking at a market that got a mathematically flawless economic report this morning.
Exactly, the CPI data.
Right, the February CPI print came in right on the nose.
Mm.
We're talking exactly the 2.4% forecast, which is that 0.3% month-over-month increase the models wanted. It was a perfect Goldilocks print.
And not too hot, not too cold. And in a normal environment, you'd expect a massive, broad-based rally on that. I mean, if you're actively trading this, you saw the S&P surge to an intraday high of 6,812 this morning.
Oh, absolutely. The algorithmic traders and the retail side saw that 2.4% headline and just hammered the buy button. But, and this is the crucial part, the real money used that exact liquidity to head for the exits.
They completely faded it.
They did. You have to think about the mechanics of how massive asset managers unwind. They can't just dump millions of shares into an empty market. They need a surge of incoming buyers to absorb that supply.
Right. They need a counterparty to take the other side of the trade. So when the automated systems rushed in this morning, institutional money was just waiting there to hand off their positions.
Methodically, too. It wasn't a panic. It was this slow, grinding distribution all day. And as we got into the close, that heavy institutional supply just completely buried the morning optimism.
Which gives us that classic shooting star pattern on the chart, right? A total failure to hold higher prices, leaving a massive zone of overhead supply right around that 6,800 level.
Exactly. And the volume confirmation tells you everything you need to know about the lack of conviction today.
Yeah, I was looking at the closing print. We hit 19.90 billion shares in total volume, which is actually below the 30-day average of 20.90 billion.
So there was no FOMO. Zero. Institutional buyers refused to chase this tape, even with inflation behaving.
Well, let's look under the hood because the breadth was awful. On the NYSE today, the advanced decline ratio was heavily negative. For every stock that went up, 2 went down.
That is incredibly weak for a day with good macro news. And if you look at who was actually taking the damage, it was the financials and the Russell 2000 small caps.
Yeah, credit-sensitive names just broke down. BlackRock, KKR, Apollo, all of them falling over 2%.
Which is a huge red flag.
Yeah.
Those asset managers are the bellwethers for the credit markets. When they start to bleed like that, it's the market telling you the cost of capital is still a massive headwind.
So if the real money is dumping credit and small caps, where are they hiding? Because they clearly funneled it all into what the strategy notes today are calling a tech island.
That's the perfect term for it. The Nasdaq's tiny gain today was basically a single stock illusion held up by Oracle.
Oh, wow. Yeah, Oracle's numbers were just absurd. A massive triple beat across the board, and they posted 44% cloud growth.
I mean, the stock was up, what, 13% at one point intraday?
Yeah, between 10 and 13, and then settled around an 8% gain. And then you add Nvidia, quietly tacking on another 1%, and it's just a handful of mega caps holding up the entire index.
It's a fascinating shift in market psychology. We're seeing this massive rotation into defensive tech. And historically, tech is the ultimate risk-on asset. You buy it for explosive growth when money is cheap.
But that paradigm is totally inverted right now. It's like the panic room analogy we were talking about before the bell.
Right.
People aren't buying big tech today because they expect massive, sudden expansion. They're buying them because these companies are sitting on mountains of cash.
Exactly. They self-fund. In a high-rate environment, Apple or Microsoft doesn't care about the bond market. They are totally insulated from the credit cycle that's crushing Apollo and KKR right now.
Their balance sheets are literally acting as an economic shield. But the notes in our deep dive today are specifically warning about this being a tech mirage.
Because it's structurally fragile. When the Nasdaq is the only pillar left standing, while industrials and financials fall apart, it's usually the last thing to drop, not the start of a new bull market.
So that brings up the big question for anyone managing risk right now. If inflation is perfectly fine at 2.4%, why are the massive funds hiding in this tech bunker? What are they terrified of?
It's not the Fed. It is 100% the geopolitical storm hitting the commodities market right now.
While retail was cheering the CPI, the institutional desks were staring at crude oil.
Brent crude hit $90 a barrel today. And WTI is grinding right up against that critical $85 watch level.
Oil is the master variable. It physically touches everything. You can't make or ship those consumer staples that drag the Dow down today without burning diesel.
High oil is basically a direct tax on the entire global economy. It's totally regressive.
And the International Energy Agency knows it. That's why they tried to intervene today with that record release of strategic oil reserves. Which, and this blew my mind watching the tape today, the market just completely ignored. Normally, an SPR release of that size crushes oil prices instantly.
Right, you'd expect a massive drop.
But we got a tiny morning dip, and then crude marched straight back up to $90. The market ate all that physical supply and just asked for more.
Because paper barrels and strategic reserves can't fix a broken supply chain. The market is pricing in the absolute worst-case scenario with Iran and the Strait of Hormuz.
Yeah, 20% of the world's daily oil goes through that choke point. If shipping companies can't get insurance or have to reroute around Africa, it doesn't matter how much backup oil the IEA dumps on the market.
Exactly. And you saw that fear priced directly into the energy sector. The XLE ETF dropped in the IEA headline, but then aggressively reversed and closed higher. That's a key reversal.
The options market is backing up that fear too.
Yeah.
Let's talk about the VIX, because this is where the mechanics get really interesting.
Oh, the VIX is screaming right now. Usually when a huge known event like a CPI report passes with no bad surprises, you get a volatility crush.
Right, the uncertainty is gone, so option premiums collapse. But the VIX didn't crush it all today.
Not even a little. It stayed incredibly sticky around 25.5 and actually went up about 2.5% after the CPI data hit.
So the market is literally telling us that domestic inflation is no longer the main risk.
The real money is hedging against energy-driven stagflation. That is the nightmare scenario. Growth dies because energy is too expensive, but inflation stays high because of supply shocks.
And if oil stays at $90, profit margins for industrials are going to compress violently. Eventually, that drags down the tech island, too.
Which is why the positioning for tomorrow's open is so critical. The derivative markets are completely wagging the dog right now, specifically around that 6,800 level on the S&P.
The gamma trap. I want to break this down for you guys listening because this is pure market mechanics. At 6,800, there is a massive gamma wall.
Yeah, it's a huge concentration of options contracts. And you have to remember, the massive dealers providing this liquidity do not want directional risk. They just want to stay delta neutral and collect premiums.
So because everyone is crowded around 6,800, these dealers are tracked in a forced algorithmic hedging loop.
Right. If the S&P dips below 6,800, the models force them to buy. If it pops above, they have to sell. It creates this invisible floor and ceiling.
It's like a magnet pinning the market in place. It has absolutely nothing to do with fundamentals or PE ratios. It's purely forced hedging.
But the danger is, what happens if that rubber band snaps? If this afternoon selling continues into tomorrow and we decisively break below 6,800, that hedging dynamic flips.
It goes from stabilizing the tape to accelerating the crash. Negative gamma takes over, and dealers are forced to aggressively short into the weakness just to cover their own exposure.
And looking at the institutional charts, there is basically zero structural support below 6,800 until you hit the 150-day moving average, which is way down at 6,742.
That's a long drop. But let's play devil's advocate here. What if the Middle East headlines cool off overnight and crude pulls back? The strategy notes laid out a pretty wild upside scenario.
The 6,800 pin to squeeze. Because everything is so compressed at this gamma wall, any relief in oil could trigger massive, rapid short covering.
And if that overhead supply clears out, the upside target in these notes is a violent move towards 6,900.
It's a highly asymmetric setup, but honestly, the historical probability of a big directional trend forming right now is low. We are in the mid-March seasonal window.
Yeah, the data shows only a 28% chance of a day 2 follow-through from today's chop.
It is a regime of chop. If you try to chase a breakout in either direction tomorrow, you are probably going to get chopped up.
Well, we do have a massive catalyst hitting tomorrow morning that might force the issue, the producer price index.
The PPI is going to be the tiebreaker. Today gave us the consumer side, but PPI is wholesale. It tells us the factory floor costs before anything hits the shelves.
If wholesale inflation is spiking because of these oil inputs, then today's Goldilocks CPI is just a lagging indicator.
Exactly. The PPI will either validate the soft landing or shatter it. And regardless of the broader chop, there's one specific day 2 play the notes highlighted that active traders need to watch.
Oh, the NEO setup. Yeah, NEO caught a big upgrade from Nomura today to a buy. citing a healthy business cycle transition. But the actual trade here isn't fundamental, it's technical.
Purely technical. The options flow shows a heavily shorted float. If NEO catches a bid tomorrow and pushes cleanly through its 50-day moving average, the models are projecting a violent short squeeze.
The targets are pointing to an 8 to 12% upside move by Friday's close if it clears that level. It's a classic high-conviction momentum setup in an otherwise messy market.
But zooming out, the big takeaway from today's deep dive is that you cannot look at macroeconomic data in a vacuum.
Right, a 2.4% CPI means nothing if supply chains are breaking down in real time.
And seeing how institutional money is reacting, using cash-rich tech as a modern equivalent to gold or treasury bonds, it completely changes how you have to read the tape.
You're not just looking at green and red arrows anymore. You are watching a mechanical tug-of-war between options dealers hedging gamma and huge funds trying to hide their footprints.
Which is exactly why you have to track the breadth and the internals, not just the index price.
Spot on. And that leaves us with one incredibly provocative thought to chew on before tomorrow's open.
Let's hear it.
If the world's largest funds are all treating mega-cap tech as a defensive bunker against global chaos, what happens to the stability of the entire financial system if tech growth actually stalls out? Because if everyone tries to sprint out of that crowded panic room at the exact same time, there won't be enough liquidity to fit through the door.
An orderly exit from a crowded safe haven does not exist.
Not a chance. Keep your eyes on that 6,800 level tomorrow. We will see you next time.